previous class we started the discussion on the stock market. There we have discussed about the importance of stock market and as well as the different instruments which are available in the stock market and what are those basic differences between them. And the next discussion about this thing is basically that how the pricing of that particular instruments are done and what are those different methods for valuation of the equity or the stock which are traded in the stock market. So, if you remember in the beginning we discussed about certain conceptual issues related to valuation. So, price of any kind of asset is nothing but the present value of the future cash flows. So, whenever we talk about the future cash flows and if you think about the stocks, what are those possible future cash flows which are related to the equity or the stock? If you see, these are basically one thing is your dividend, second thing is your free cash flow to equity, then we have the operating cash flow to the equity. So, these are three different cash flows which are basically available, the operating cash flow to the equity or operating cash flow to the firm. So, generally the operating cash flow is always calculated with respect to the company or the firm, it is not with respect to only equity. So, there we have three types of cash flows, we have dividend, we have free cash flow and we have operating cash flow. And already if you remember we also discussed about that three inputs which are required for the valuation of any kind of asset. One is your cash flow, second one is the growth of the cash flow or the growth rate of the cash flow, and the third thing we want the discount rate, and obviously time is another factor or the time period is another factor. So, we have the four inputs or mostly the major inputs are these three which are quite important for the valuation of any type of asset. So, with reference to that if you think about the equity or the stock, we also need this four inputs, we need cash flow, we need growth rate of the cash flow, we need discount rate, we need the time. So, here already we discussed that dividend is the first cash flow which is related to equity or the stock, and we have the growth rate of the cash flow means growth rate of the dividend, then finally the discount rate which is nothing but the cost of equity in the context of the equity, because that is the expected return what we can get it from that particular investment. Then we have the time period. So, these are the four inputs always we need whenever we go for the valuation of the equity using the dividend as the cash flow. So, if you go back the formula is basically nothing but it is dt upon 1 plus r to the power t, and your r is nothing but the discount rate which is in this case the cost of equity, and you can expand it d1 divided by 1 plus r to the power n plus d2 divided by 1 plus r to the power 2 and so on, up to if you have the n number of cash flows and the period is n, then it is d n divided by 1 plus r to the power n, and finally, we can find out the P 0. The P 0 is nothing but the intrinsic value of that particular equity. So, this is what basically the valuation principle or the valuation formula which is used for valuation of the equity using dividend as the cash flow. Then if you see there are certain things related to this. One is that the different ways the valuation is done. Then one particular thing, if you take certain assumption that let the dividend is growing at a constant rate, the growth of the dividend is not changing, this is number one, and this particular growth will continue for an indefinite period of time. There is no specific period is mentioned that up to what period this growth rate will be this much, let that is basically continue for an indefinite period of time, and another assumption we are taking that dividend what growth rate we have, that is less than the cost of equity. That means, the required rate of return will be greater than the indefinite growth of the particular cash flow or the growth rate of the particular cash flow. So, then if you see that if you expand that particular formula, if you simplify that formula, finally we are getting P 0 is equal to d 1 divided by r minus g. Then what this d 1 is equal to? This is nothing but the d 0 into 1 plus g divided by the r minus g. So, d 0 is the initial dividend what the company is paying, and g is equal to the growth rate of the dividend, r is equal to the discount rate or the cost of equity, and this is the way the P 0 is equal to the intrinsic value of that particular equity, what basically we are calculating using dividend as the cash flow. So, this is the way basically this is one particular model which basically talks about the valuation of equity, which popularly known as the Gordon's growth model. Gordon has given this particular concept assuming that the growth rate of the dividend remains constant for a indefinite period of time. So, let us see how this particular thing can be derived. If you see, we can start with the initial equation P 0 is equal to your t is equal to 1 up to n, summation t is equal to 1 up to n dt by 1 plus r to the power t, which is nothing but d 1 by 1 plus r to the power 1 plus d 2 divided by 1 plus r to the power 2 and so on up to dn divided by 1 plus r to the power n. Then if you assume that the growth rate of g is constant and d 0 is equal to the initial dividend. So, here if you see this d 0 which is the initial dividend, g is equal to the constant growth rate, then you can expand it in this way. D 1 is nothing but d 0 into 1 plus g to the power 1 divided by 1 plus r to the power 1, and d 0 into 1 plus g to the power 2 divided by 1 plus r to the power 2 and so on, and finally, you are getting d 0 into 1 plus g to the power n divided by 1 plus r to the power n. Then if you take common d 0, you can take common because d 0 is involved in all the terms in that particular equation. Then what you can find d 0, if you take the common from all the terms, then we are finding d 0, then you can take the bracket, then you can find out 1 plus g to the power n divided by 1 plus r to the power n and so on, and finally, we are getting 1 plus g to the power n divided by 1 plus r to the power n. Then what you can do, let you multiply both sides by 1 plus r divided by 1 plus g. So, then P 0 into 1 plus r by 1 plus g is equal to d 0 into this 1 plus g to the power by 1 plus r plus 1 plus g to the power 2 divided by 1 plus r to the power 2 and so on, multiplied by 1 plus r divided by 1 plus g. Then 1 plus g will be cancelled in one place, then finally, you are finding 1 plus r by 1 plus r, then you are getting 1. Then other term will remain 1 plus g by 1 plus r plus 1 plus g to the power 2 by 1 plus r to the power 2 and so on, and finally, you are getting 1 plus g to the power n divided by 1 plus r to the power n. Then what you can do, you subtract this equation from this equation, then what you will find that all the terms will be cancelled, and finally, what you get, you are only finding that P 0 into 1 plus r divided by 1 plus g minus 1, you can take the 1 this side, then you will be getting d 0 into 1 minus this 1 plus g to the power n divided by 1 plus r to the power n. Then as you know that r is greater than g, then automatically if n tends to infinity, then this term will be very negligible, it will be very much close to 0. So, then 1 plus g to the power n divided by 1 plus r to the power n will be closely equal to 0, then you can cancel that particular term. Then finally, what you can find out that if you simplify that equation, then finally, we will find out P 0 into r minus g is equal to d 0 into 1 plus g. Then obviously, then P 0 is equal to d 0 into 1 plus g divided by r minus g, and d 0 into 1 plus g is nothing but the d 1. So, this is the way this particular formula can be derived, and this formula basically talks about where the growth rate is constant. Growth rate is constant for a indefinite period of time. Remember, for indefinite period of time. So, this is basically very important in this context, that whenever the growth rate remains constant for indefinite period of time, then the value of equity is nothing but the d 1 upon r minus g, and r is equal to the cost of equity and g is equal to the growth rate of the dividends. So, this is the way the Gordon growth model can be derived, or the constant growth model can be derived. So, then you can move that, not necessary that always from the beginning whatever growth rate the company always gets, the same growth rate will continue for indefinite period of time, that may not be true. Let we can relax that assumption that let in the beginning the growth rate is relatively higher and over the period the growth rate again come down to a steady growth rate. So, here the assumption basically here what basically we can take, the growth rate is constant for a particular period of time, maybe supernormal growth rate in the beginning, then it can come down. We will see that thing further, then how the formula gets changed. But if you use that equation and find out a value of that particular equity, then let the dividend is 4 rupees and the dividend are expected to grow at a rate of 6%, that means G is equal to 6%. Then required rate of return is 15%, means your R is equal to 15%. Then what will the value? Then you can use directly that formula. Your D0 is equal to 4 into 1 plus 0.06, which is the growth rate. What you will be getting 4.24. Then you can discount that 4.24 with respect to that discount rate, which is 15% in this case. Then 4.24 divided by 0.15 minus 0.16, that will give you 47.11 rupees. So, this is the way basically the valuation of equity is done if the growth rate remains constant for an indefinite period of time. That is very easy to calculate, because that is the way basically we can all directly you can, if you have the D0 value, then you can use that formula and get it this thing. And already I told you that is another model called the two-stage growth model. There we are assuming there are two different growth rates in two different periods, and there is a high growth rate in the beginning, and after a certain period of time the growth rate basically will reduce and it remains stable for an indefinite period of time. If there are two different growth rates which are available, in one period there is a supernormal growth rate and another period there is a stable growth rate which is relatively lower. So, in that context, then how we can calculate the value of the stock? The value of the stock can be calculated. You can calculate the present value of the cash flow in the extraordinary growth phase or the supernormal growth phase. Then you can find out the present value of the terminal price. Then what is the terminal price? The terminal price is basically what? Whatever expected cash flow you will be getting after the supernormal growth rate period will be over. Then if you discount that particular price with respect to that proper discount rate whatever we have in that particular period of time, then the terminal price of that particular stock can be calculated. So, now if you observe, because we have the two different growth stages, we have two different terms what we can use it for the valuation of that equity. One is the high growth rate term and another one is the constant growth rate term or the stable growth rate term. So, if you see this one, this term talks about the high growth rate term and this term talks about the constant growth rate term. And here the P n which what we have taken, the P n is basically nothing but whatever expected dividend per share you are getting after the supernormal growth rate over. The supernormal growth rate over let at the period of n, then what is the expected dividend you are getting at the period n plus 1, then that n plus 1, and we are assuming that that particular dividend growth rate will remain constant over a period of time, then we can find out your what is the stable cost of equity or the required rate of return and what is the stable growth rate. So, if you can do that, then your P n can be calculated. So, that is the way basically the terminal price can be calculated and the terminal price can be discounted and to find out the present value. Then that present value and this present value if you add up, then you can find out the value of the stock in that particular context. So, already I explained that thing. Here your RE is equal to the cost of equity, where SG represents the high growth period and ST represents the stable growth period, and Pn is equal to your terminal price of the terminal value at the end of year 10. G is equal to the extraordinary growth rate for the first 10 years, and your Gn is equal to the steady growth rate forever after the supernormal growth rate period gets over. So, now we can see that a little bit you can expand this particular equation. If you assume that the growth rate and the dividend payout ratio do not change in the first 10 years, then the formula can be written as this way. You can use this same constant growth rate formula, that DPS 0 into 1 plus g into 1 minus 1 plus g to the power n divided by 1 plus your r to the power n, and here the r is, because it is the first period, the r is nothing but the high growth rate period r, the cost of equity in the context of high growth period. Then your r e minus g, r minus g, which is nothing but the high growth period cost of equity minus the growth rate of the dividend in that particular period, plus your DPS n plus 1 divided by, because you are discounting it with respect to this 1 plus r e s g to the power n, and finally, you are using the constant growth model, and you are, that is why you are getting it. That means, DPS n plus 1 divided by 1 plus r e s g to the power n, then whatever price you are getting, that again you are discounting it with respect to this stable growth cost of equity, then finally, the present value of that particular price or terminal price can be calculated. So, DPS n plus 1 divided by 1 plus r e to the power n, which is basically nothing but the value what we are getting in the end of the supernormal period. So, let us see one example, then it will be more clear for you. Let there are two stages here we have taken, one is high growth stage, another one is stable stage. Earnings per share, you assume that let 4 rupees, dividend per share is 1.5 rupees, then dividend payout ratio has become 37.5%, the return on equity is 30%, cost of equity is 10%, which is your RESG, this is your basically your RESG. Then we have the growth rate, which is the growth rate in the supernormal period, and this is your period which is continued, the growth rate, high growth rate continues, that is 5 years. Then after 5 years, your returns on ratio let become 44.44%, that you are getting, because after that the growth rate has become 8% and your return on equity rate for the company is 18%, that already you know that your growth is nothing but the returns on ratio multiplied by the return on equity. So, if your growth is given and ROE is given, then returns on ratio can be calculated, that is 44.44 in this percent, this is 8% divided by the 18%, that you can get it this one. Then dividend payout ratio is nothing but 1 minus your returns on ratio, that is 55.55% in this case, that you got it. Then after using this data, you can use it for calculation of your value of the equity. Then how basically you are trying to do this? If you see, then you can put those values in that formula. Then 1.5, which is the initial dividend per share, into 1.15, 15 is the growth rate, 15% is the growth rate, then 1 plus g, then 1.15 into 1 minus 1 plus g to the power n, that means n is equal to 5, 1.15 to the power n divided by 1 plus r to the power n. R in the first period is 10%, then 1.1 to the power 5. Then finally, what we are getting, that divided by r minus g, r in that high growth period is 10%, then 0.1 minus 0.15, then you are getting 8.58 rupees. Then expected earnings per share after the nth period is over, that means the first period was 15% growth rate, initial earnings was 4 rupees, then 4 rupees multiplied by 1.15 to the power 5 multiplied by 1.08, why we are multiplying 1.08? Because in the 6th year the growth rate was 8%. Then what we are getting 8.68. Then you know that your dividend is 55.55%, your dividend payout ratio, then 8.68 into 0.5555, you are getting 4.82. Then that 4.82, which is your expected dividend, divided by your next year's cost of equity, that is 12%, which is given, minus GN, which is the stable growth rate, then 4.82 divided by 0.12 minus 0.08, what you are getting 120.66 rupees. Then what if you can calculate the present value of this, then you have to discount it with respect to the discount rate, that is 12% in the stable growth period, then 120.66 divided by 1.12 to the power 5, then you are getting 68.47 rupees. So, in the first period it was 8.58 rupees, next period is 68.47 rupees, then if you add up, then the value of equity will be 77.05 rupees. So, this is the way the two stage growth model works in the market. There are other models also, there are 3 stage model, there are H model and all these things. For that you can go for any valuation books which talks about in detail about those, but here I have just introduced that 2 concepts where the valuation of equity can be carried out. So, then already I told you there are two another kind of cash flow which is related to the company, that is your operating cash flow, and how the operating cash flow is calculated, that we have explained in the previous class. You can use this same formula, that your OCF instead of dividend you can calculate this OCF, operating cash flow, divided by 1 plus, but here you remember your cost of capital is considered as the discount rate, and here it is not the cost of equity. Why we are not talking about cost of equity? Because your cash flow what we are considering, that is with respect to the firm, not with respect to the equity only. So, WACC is what? Already you know that what is WACC. WACC basically your weighted average of cost of capital, weighted average of the cost of capital. So, how to calculate the weighted of cost average of cost of capital? That is your cost of equity multiplied by the percentage of equity, that means your E upon D plus E, D is equal to your debt, plus your cost of debt, let RC into D upon D plus E. So, if you know the cost of equity, you know the cost of debt, and how much percentage of equity the company has and how much percentage of debt the company has, then you can find out the WACC. The weighted average of cost of capital can be calculated. These are the weights or the percentage which is related to equity and the debt. Then what you can do? You can discount with respect to the WACC, and the operating cash flow will be discounted, and finally, the value of the particular company can be calculated. So, again same thing, if you are assuming that there is a constant growth rate for the OCF, then you can use the same Gordon formula what we have derived, that your B is equal to or P is equal to your D 1 divided by R minus G. In this case, your OCF 1 divided by WACC minus G of growth rate of the OCF, and your OCF 1 is nothing but OCF 0 into 1 plus G divided by your WACC minus the growth rate of the OCF. Then you can calculate the operating cash flow. But if you are going for the free cash flow, then you can also use the same thing, the operating cash flow minus capital expenditure plus net debt issued, that will give you the free cash flow. Then if you have the free cash flow, the free cash flow is basically with respect to equity. So, here again your R is equal to the cost of equity. Once you calculate the free cash flow, you can already have the cost of equity with you, and you know what is cost of equity. Again I am reminding you, the cost of equity basically you can calculate it, your RE is equal to, you can calculate your RF plus beta into RM minus RF, and here your RF is basically your risk free rate. You can use the treasury bill rate or any other rate as a risk free rate. RM is equal to the market rate, and here your market rate is basically you can return from the Sensex, your BSE Sensex, you can take the return from the NSE Nifty, so on. Any kind of market index return can be calculated as considered as RM, and RF is equal to the risk free rate, and you can find out your RA, your R, and once the R is calculated, you can calculate the free cash flow, then you discount with respect to that to find out the value of the particular stock. So, this is another way of calculation of the value of the stock. But these are basically these are the formulas which are used to calculate the intrinsic value of the stock. So, another one is basically what your relative valuation techniques, and the relative valuation techniques are used for what reason? To decide or to make a comparison between the different stocks which are available in the market. So, whenever anybody wants to invest in the market, then what kind of stock they should choose on the basis of their objective, that basically is decided by the relative valuation techniques. So, whenever we go for the relative valuation technique, we always compare between the similar stocks using certain ratios, using certain relative valuation ratios. What are those relative ratios we use? The relative ratios can be used with respect to earnings, with respect to cash flow, with respect to book value of the company or book value of the stock, or it can be also with respect to sales. Why basically we go for the using those kind of ratio analysis for doing this? Because the ratio analysis can normalize the data, and that normality can help you to make a comparison in a better way. So, there are different ratios. The most popular ratio is basically based on the price earning ratio. You might have heard about P ratio, that P ratio is the most popular method for the valuation of the equity, that is price earning ratio. So, let us see that how those ratios are basically used for the valuation of that. Then P ratio is nothing but the current market price upon the expected earnings for the share. So, if you have the expected earnings per share, then you have the current market price, that will give you the P ratio. And P ratio means, what is the interpretation of the P ratio? The P ratio interprets that to get one unit of the return from the, or 1 unit or 1 rupee or $1 value of investment for a particular stock, you have to spend 5 rupees. So, if you are spending 5 rupees, you are getting 1 rupees. So, lower the P, better for the investor. So, lower the P, better for the investor, because there is a growth potential of that particular stock. You are investing less and getting more. So, that is the way the P ratio is interpreted in the market. Then we can see that there is a relationship you can establish between the dividend discount model and the P ratio. If you remember, your P is equal to nothing but D1 by R minus G or the K minus G, whatever way you can represent the required rate of return of the stock. Then if you divide E in both sides, then your D1 upon E divided by K minus G or R minus G will give you the value of the P ratio. Then what are those factors which then affect the P ratio? The P ratio is determined by the expected dividend payout ratio. It is also determined by the required rate of return of the stock, that means cost of equity, then the growth rate of the dividends. So, those factors also affect the price earning ratio of the company, and already told you that lower the P, better for the investor for the investment in the market. So, you choose those stocks which P ratio is relatively low. So, any change of the K or G will have a larger impact. If you see the example, dividend is constant, required rate of return is 15%, expected growth rate 10%, D by E is 0.5, but K is equal to 0.15, G is equal to 0.1, then P by E has become 10, but let G has changed, K has changed from 15 to 16%, P by E become 8.33. Let K has become remain 0.15, G has changed to 0.11, then it has become 12.5. That both have changed, let from 15 to it has become 14%, from 10 to it has become 11%, then P becomes 16.66. So, any small changes in the K or G or R or G will change this P ratio drastically. So, that is why we can say that these are the major factors which affect the P ratio. Then we have another ratio called price to cash flow. Some people argue that the companies can manipulate the earnings, but the cash flow is less prone to the manipulation. So, because of that, the cash flow is very important for the valuation and as well as the credit analysis of the company. So, you can also find out the market price upon the cash flow, expected cash flow for share of that particular firm, and lower the cash flow, again those particular stocks are considered the value stocks. So, that is the way basically you can interpret these things in the market. Then we have price to book ratio. The price to book ratio is a proxy for the growth opportunity, and the previous studies have shown that the price to book ratio and stock return, there is an inverse relationship. That means, if the price to book ratio is very much high, that means what? The market value of that particular company is already high, that means the company is already overvalued. So, in that context, the expectation from that particular stock is relatively less, or the return, expected return from the stock can be less, because market has already overvalued that. But the price to book ratio is very high, is very low, then what we can say that book value is relatively high, but earnings market price is relatively low. That means, market has undervalued this stock, and there is a possibility that the price of the stock will further grow up. So, in that context, lower the price to book ratio, that means the company has more growth opportunity, expected growth opportunity is higher, then it is better, is a better candidate for the investment in the market. So, this is the way the price to book ratio is used in the market. Then we have price to sales ratio, and the ratio basically varies with the industry. but relative comparison using price to sales ratio should be between the firms within the similar industries, because those are affected by some kind of seasonal and cyclical factors in the market. So, these are the references what you can go through to know more about this thing, and further we will be discussing about the markets and all these things related to the equity or the stock. Thank you.